Rents are rising. The average rent for a two-bedroom was up 2% in 2020, up 3% in 2021, up 5.6% in 2023, and then up 8% in 2024. That's a whopping 16% increase in 4 years for a rental unit of that size across the country. Not to mention that in 2024, there was an average 23.5% increase in rent when units changed from one tenant to another. How did we get here? Let's unravel what happened to rent. In Canada, about a third of people rent the place they live, a number that's on the rise. That means being part of what's known as the private rental market.
The private rental market have the basic function of being profitable. And for any business to be profitable, there are two things to do. You reduce costs, you increase prices, so your profit margin is higher. Any private landlord will try to run a profitable operation, so they'll try to increase rents. And there may or may not be regulations on how much they increase rents by.
Historically in Canada, the rental market was seen as like one step on what they call the property ladder. As a young person, you would rent until you could afford to buy a home. That was always the role that policymakers saw rental housing providing. Increasingly, of course, as homes have gotten out of reach for so many people, renting is not one step on the property ladder. It is the final destination for a lot of people. What that has meant is people who otherwise have very high incomes, and maybe even 10, 15 years ago, they would have been able to afford a home. Now they are renting.
And those higher income earners who are now renting instead of buying can often afford to spend more on a unit, pushing up the price for everyone else.
That is going to naturally push people into smaller units than they would otherwise like to occupy, right? And of course, some people get pushed out of rental housing altogether.
In the current market, that increase in demand is combined with a lack of supply. Only 2% of rental units are vacant across the country. And when supply doesn't meet demand, there is significant pressure for rental prices to rise. The high cost of everything, including housing, causes a spike in inflation. The Bank of Canada increases interest rates to slow down inflation. That works to slow down a lot of spending on consumer goods. But housing is different because everyone needs a place to live. And that 2% vacancy rate doesn't leave a lot of options for renters. At the same time, those increased interest rates also result in higher mortgage rates, including for landlords who then raise rental prices to make up the difference. It's a real catch-22.
There will always be a struggle between tenants who want to pay less and landlords who want to extract more income from them. So that's the nature of a private rental market. And that has not fundamentally changed throughout Canadian history, throughout, anywhere where you see a private rental market.
That explains how some of the recent rise in rental prices is about market forces. But market forces aren't the only cause, and not all the causes are recent. Some of what's happening now actually started 3 decades ago, in the 1990s, when the real estate market went through a fundamental shift that is still resonating today.
What has changed in the last 30 years, give or take, is that we've seen the arrival of new types of landlords, new investor landlords, large and small, that come to the whole real estate industry with a different mindset.
That different mindset is part of a phenomenon known as the financialization of housing. The financialization of housing is when housing is treated as a way to generate income for shareholders, rather than a human right or a social good. It opened the door for smaller investors to buy into the real estate market, including residential rental properties, through the creation of something called a Real Estate Investment Trust, or REIT. To understand how it works, let's take a step back 30 years to unravel why the financialization of housing happened. In the mid-90s, the Canadian government changed tax laws to allow for new and different tax breaks to real estate funds. This made it more attractive to invest in the real estate market, as the income from these REITs was being passed directly to investors with a lower tax rate than other forms of real estate investments. And it allowed for smaller shareholders to access real estate without having to tie up a large amount of money. It was also the same decade where the federal government withdrew from funding any social housing at all, which meant no more federal funding for building affordable housing. It became the responsibility of the provinces. At the same time, laws were changed to loosen rent control and make it easier to evict existing tenants and charge higher rents to new tenants. All 3 of these factors, changed tax laws, withdrawal of funding for social housing, and less rent control, made investing in rental properties more attractive. And it paved the way for the first rental housing real estate investment trusts, or REITs, to be created in Ontario in the 90s.
These are some of the culprits when we talk about the financialization of housing. REITs own these apartment buildings and they operate them as income generators for, in some cases, like pension funds.
What this has done is make housing more like commodities, just a thing that can be bought or sold, like gold or stocks, rather than something that people need to survive every day. That disconnect is exacerbated when housing is treated like any other investment. Rental housing as an asset is everywhere in the current investment market. The Ontario Teachers' Pension Plan is invested in housing, the Federal Public Servants' Pension Plan, popular mutual funds are invested in residential REITs, and all of these places need to make money for their investors, many of who are average, everyday Canadians. And especially with REITs, the only way they can do this is by raising rents or charging fees to tenants.
Any private landlord will try to run a profitable operation. And there's two ways of doing this: reduce costs or increase rents. So they'll try to increase rents.
You see, REITs exist to pass a profit from the property directly to shareholders, and the REIT has to share the bulk of that profit with their investors in order to maintain their specific tax status. Because REITs themselves don't get taxed on that profit as long as they pass it to their shareholders, and the shareholders pay the taxes on it, but only if they don't hold those shares in a tax-free account like a TFSA or an RRSP.
They are calculating whether their investment in real estate is more profitable than alternative investments, because that's how they're thinking. They have money, they have to invest on something, and that something has to be more profitable than the alternative. So they come into the market with really high expectations of high returns on investment and in a fairly short amount of time, because they have to report back to their investors and say, this was a good investment, give us more money, we're gonna do it again. So what that in practice has created is a kind of like a predatory landlordism that is even more aggressive than the traditional type of landlordism. And among other things, we see higher and quicker price increases, we see more pressures on evictions and other such things.
And in the US, large REITs and property management companies associated with them are at the center of a Department of Justice antitrust lawsuit that alleges these companies colluded to set artificially higher prices for rent across the country. A lawsuit that has some in Canada proposing a class action against companies here as well. So, to sum it up, REITs and private equity have changed the nature of the rental market, making it more aggressive and less friendly for renters, while allowing investors to take advantage of tax breaks. But not all landlords get those breaks.
Then at the other end of the market, a huge amount of our rental supply is basically mom and pop landlords, if you want to think of it that way. Maybe they own a unit in a condo. Maybe it's a basement of their home. Maybe they own one or two rental homes, but just a huge amount of the rental market is actually held by a very large number of very small holders. So it's a very different dynamic depending on what kind of landlord you're talking about.
Mom and pop landlords don't have the same tax breaks as the big REITs do, nor do they have the same resources when it comes to dealing with problem tenants, or spreading losses over multiple properties, or even taking advantage of different regional markets. And while mom and pop landlords still have the largest portion of the overall rental market, big REITs now own an estimated 20 to 30% of all of the purpose-built multifamily rental housing across the country. And they're growing. REITs are starting to get into the development side of things. They're building new rentals that add to the supply of units available, but would also be subject to the same business practices of current REIT-owned buildings. And the pressure of REIT-owned rental units is significant. So, where does all of this leave us?
I think we cannot square that circle on having housing being very profitable and very affordable. We just can't. We have to choose one or the other. So if we choose affordability, the long-term solution is to increase the share of all rental units that are not for profit. Right now in Canada is only about 4% of all housing and about 12% of all rental housing that is not for profit. We need to increase that and increase it by a lot. We need to double that and then double again and double again until non-market housing is a very significant share of all housing.